Alrighty, so we'll just go through that again just so you can see. So there's our disclaimer. So here's my contact details, A. Smith of Vincent, and phone number. Our agenda here, and ATO and government announcements. Hopefully that's working for everybody. Okay, so work-related expenses. So the ATO has launched its biggest ever education campaign with regards to work-related expenses. They've indicated they'll be directly contacting over 3 million taxpayers, as well as issuing specialised guides and toolkits for taxpayers, agents, and employers and industry bodies. In 2017, work-related expenses totaled $21.3 billion. So you can see that this is a risk area for the ATO that really rates highly. The focus is on all work-related areas as well, so car travel, working from home, home office costs, clothing, and self-education expenses. So the ATO have noticed a rise in the number of overclaimed expenses and claiming personal expenses. So this is really just overclaiming and also a lack of apportionment. Also a high level of mistakes, errors, and questionable claims for home office expenses. So that area itself is prompted some increased attention. This is really important, this next bit as well, just for accountants as well. In the sense of that we need to be contacting our clients directly and making sure that they're not claiming expenses that they've never paid for, expenses that their employer has reimbursed, or private and expenses with no supporting records. So as accountants, we need to put a priority that of educating our clients and documenting that we've had those conversations with them, and giving them the right sort of tools that they need to substantiate their claims. So the ATO may contact the employer as well to confirm claims. So that's another thing as well. We need to be really careful. I was reading some figures actually, and interestingly, so in 2017, 6 million people claimed work-related clothing and laundry, totaling $1.8 billion. And as you can imagine, the ATO is fairly skeptical about that 6 million people, which is about half of all taxpayers claiming clothing. And a quarter of all those claims were $150. So you can sort of understand where they're coming from. And as usual with all these things, record keeping is a key focus for the ATO, and they will disallow claims where records were not kept to substantiate the expenses, and that they were incurred for and related to work. Okay, so the next one is some new GST withholding on purchase of new residential premises or new subdivisions of potential residential land. So this applies from 1 July 2018. And it relates to property developers needing to give written notification to purchasers whether and also how much the purchaser will need to withhold. Penalties apply for breaching new rules. So penalties apply from the seller not giving written notification, and also if that seller did give written notification, then the onus is then on the purchaser, and they can also get some penalties as well. So a good ruling here is that LCR 2018/4. That's predominantly about some of the transitional rules for contracts that were entered into pre 1 July 2018, but settle after that date. And it also highlights the types of supply covered and the GST that might be payable. So whether that's 1/11 of the contract price, 7% if the margin scheme is used, or 10% if it's between associates. There's a couple of forms as well that we need to be aware of. The first one is the GST on property settlement. So that's just to notify when the contract has been entered into, and we need to advise the ATO. And the second form there is, the actual confirmation date or the settlement date, confirming those things to the ATO as well. Okay, so this is an interesting one. And it's an update on the ATO's website, providing some guidance on how the ATO interpret if a sale of an asset is a mere realisation versus carrying on a business or isolated profit-making scheme. So we always need to consider this, whether it's just sort of a mum and dad selling real estate or property developers. This is probably, if you get some time, take a look on the website and read through some of these examples on there. It's really good. They've done a good job on focusing on real life situations, and they've actually got 12 examples that the ATO have recently encountered. Some of the factors that the ATO take into account in making their decisions are: is the agreement to develop and sell your land a mere realisation, or a disposal either in the course of a business or as part of a profit-making undertaking or plan? The capital versus revenue characterisation, property development agreements, timing of return of income and deductions, and land banking entities with associated property development entities. The next one here is an updated practical compliance guideline. This is in relation to unpaid present entitlements. We have those 3 investment options that are available after Bamford's case a couple of years ago. And this one here applies to, applies where a UPE has been treated in accordance with investment option 1, which is a 7-year interest-only loan on or before 30 June 2012. So the trustees under this option are obliged to repay the principal of the loan at the end of the loan term. Failure to meet this condition will give rise to the unpaid principal being treated as a Div 7A loan and a deemed dividend at the end of the income year in which the loan matures. So you can get around it, and how you do that is you put in place a new 7-year loan in accordance with Section 109N, and basically that's just a loan agreement with principal and interest repayments over 7 years between the subtrust and the private company beneficiary before the company's lodgement date. We need to be careful here. So if some of the facts and circumstances indicate to the ATO there was never an intention to repay, then it may lead the Commissioner to think that the arrangement was a scam, fraud or evasion. So we just need to be careful with that. Some key dates for the sub-trust arrangements that are maturing in the 19 income year. So we got here the 14th of May 2019 is the deadline for the principal loan and final interest to repaid. 15 May 2020 is the deadline for the trustee to enter into a new 7-year compliant loan agreement if the principal is not repaid in full. And then 30 June 2020 is the due date for the first minimum yearly repayment under the new loan. Okay, some new and proposed law now. And the first one here is we've got the accelerated depreciation for small business entities. I think that bill took quite some time. I think it was originally came out on the 24th of May, but dates sort of back to the budget in the 2017 financial year. So it's good that we've finally got some closure on it. It extends the date basically for which small business entities can claim that 20,000 instant write-off. So the dates now are the asset first acquired on or after 12th of May 2015 and first used or ready to installed and ready for use on or before 30 June 2019. And these are assets that cost less than $20,000. For assets costing more than $20,000, they can be added to the small business simplified depreciation pool. And then that pool can be immediately deducted if it falls below $20,000 at the end of the income year. The bill also applies to small business entities that are subject to the 5-year lockout rule and depreciation outside of these dates. So before 12th of May 2015 or after 30 June 2019, the limit is $1,000. So Black Economy Task Force measures number 2. So this was first introduced into the House of Reps on 20 September 2018. The bill proposes to remove tax deductibility of certain payments if the associated withholding and reporting obligations have not been complied with to the ATO. So this is expanding the taxable payments reporting system to 3 new industries, being road freight, information technology, and security investigation or surveillance. So these payments, or this actually applies from 1 July 2019, and is sort of in addition to the cleaning and courier industries that were already announced, and I think their date is 1 July 2018. So we just need to report this information to the ATO about payments made to these contractors in these industries. And the bill also proposes to amend the Excise Acts to establish a framework to make excise duty on tobacco due and payable at the time of manufacture. Okay, so lower corporate tax rates, the big one here. This was passed by the Senate on the 23rd of August without amendment. It is still waiting royal assent. It applies to the 2018 income year and onwards. So under this new bill, a corporate tax entity will qualify for the lower tax rate in an income year if no more than 80% of the corporate tax entity's assessable income for that income year is base rate entity passive income, and the aggregated turnover of the corporate tax entity for the income year is less than the aggregated turnover threshold. So we've covered this. It's sort of been going on for a long time now, but we've covered it before in previous tax updates. But just a reminder on what that base rate entity passive income is. And that's dividends other than non-portfolio dividend. So non-portfolio dividend is where a shareholder owns more than 10% of the voting interest in a company. So it's dividends other than those. Interest income, royalties, rent, net capital gains, and trusts and partnership distributions that are base rate entity passive income. So we use the look-through measures to look at the nature of that income that comes from a trust and or a partnership. So the enterprise tax plan number 2. So basically, this is dead in the water. This one, it was defeated in the Senate on the 22nd of August. It had proposed to progressively extend the 27.5 tax rate to all corporate tax entities, regardless of turnover, by the 2024 income year. But that no longer is applied now. So what it means, it limits the availability of the 27.5 corporate tax rate to the 18-year base rate entity with a turnover not exceeding 25 million, and then the 19 and later years not exceeding 50 million. All other companies will remain subject to the 30% tax rate. So just a bit of a summary of what's happened, I guess, in recent years, starting from the 17 year. So in that year, I guess the status there to have access to it is a small business entity. The conditions is aggregated turnover of less than 10 million, and you needed to be carrying on a business in accordance with that tax ruling. Now, that tax ruling had quite a wide interpretation in the sense that, I guess, if a company was holding shares and it had sort of been doing so in the aim of making profit to its shareholders, then it could be considered to be carrying on a business. So it had a very wide interpretation. The conditions satisfied yes and no, 27.5 and 30%. So from the 18 year and onwards, we're looking at now a base rate entity. The difference between 18 is the 25 million and onwards is the 50 million. And so that base rate entity passive income less than 80%, then we can access the 27.5% tax rate. So what does that mean in terms of franking credits? So it's just a reminder, basically. So the company must assume its aggregated turnover, assessable income, and base rate entity passive income will be the same as the 17 income year. So for the 17-18 income year, the corporate tax rate for imputation purposes is 27.5%. If either of the following apply, the company's aggregated turnover in the 17 income year was less than 25 million, and 80% or less of its assessable income was base rate entity passive income, or the entity did not exist in the prior year. Now, that did not exist is actually did not exist, and an entity that is just simply in existence but passive or doesn't do anything doesn't count. So otherwise, the company's corporate tax rate for imputation purposes is 30%. Now, just going back to the previous slide here, So in terms of the 18 financial year and working out the imputation rate for the 18 financial year, you need to apply those same set of circumstances in that middle one there to 2017. And that's how you can work out if you are franking at 27.5% or 30%. And same thing with a 17 year. So you need to apply those same principles back into the 16 year, and then that's how you work out if you're franking at 27% or 27.5 or 30%. So this leads on to the question, so what happens if you have wrong tax rate in frankable distributions? And the ATO expects you to notify shareholders in writing with the correct tax rate. And it may be for the 17 income year or 18 income year. And you should be doing that as soon as practically possible. Okay, so moving on to some case law now. And a fairly interesting one, I think, is this one here. So Harding versus the Commissioner. And the taxpayer was unsuccessful, basically, in arguing that he had a permanent place of abode outside of Australia. So the facts of this case were, in June 2009, the taxpayer left the family home in Australia to work in Saudi Arabia as an aircraft engineer. Was initially under a 12-month contract, but as they always seem to do, it was extended over time. His wife and children remained living in the family home in Australia in expectation that they would join him later, but didn't happen. They subsequently had a marriage breakdown and they separated in October 2011. While working in Saudi Arabia, the taxpayer resided in a 2-bedroom service apartment in Bahrain, moving then to a single bedroom for 12 months and then again to another apartment. And I guess on the most important thing here is on each occasion that he moved, he was able to pack all of his belongings into a few suitcases. Now, the reason why that's important is because of that principle there, that permanent place of abode, which we'll go into. So the taxpayer argued he was a foreign resident in the 2011 income year, and the Commissioner audited the taxpayer and issued amended assessment for the 2011 year to include the foreign source income from Saudi Arabia on the basis that the taxpayer was an Australian resident. So Australian residents get taxed on worldwide income, so that's why they were bringing that in. So the decision that they came to, the taxpayer didn't establish a permanent place of abode overseas, as is required under the domicile test, even though the taxpayer was able to demonstrate that he did not intend to return to live in Australia. And I think that permanent place of abode is important. Carrying those suitcases, moving from apartment to apartment, is fairly clear that he wasn't actually in a permanent place. And another interesting thing is quite often we'll have people that go over to the Middle East to work there. I don't actually think you can sign a lease actually, or even buy a place over there. So if you can't buy real estate, then how can you argue that you're establishing a permanent place of abode, which is that really important factor in this domicile test in determining whether you're an Australian resident or not. So the accommodation used by the taxpayer was temporary nature and type. The taxpayer's presence in the accommodation was temporary and only intended to continue until he was joined by his wife and youngest son, at which time they would have acquired permanent accommodation. So the next one here is against the Commissioner against Thomas and Oars at the High Court, which to me seemed quite a simple case, I guess. But so the resolution to allow franking credits to be streamed between trust beneficiaries separately from the dividends. So that's, I guess, the actual dividend going one way and the franking credits going another way to a different person. So this trustee attempted to distribute the trust incomes, 90% of the franking credits and foreign income, and 1% of the remaining net income to Mr. Thomas, and the balance of the net income to a private company. The trustee resolution and subsequent Supreme Court approval of these do not override the application of the tax law. So basically, the franking credits are aligned to where the dividends actually are allocated. Okay, that's all for today. If you have any questions, my contact details are at the very start there. Feel free to ask anything. We know that some of these issues are quite complicated, so we're here to help. Any questions, feel free to flick them through to us. Otherwise, thank you very much for your time.